Let's talk about returns. Not the kind you get from sending something back to a store, but investment returns. Specifically, we're going to break down the difference between absolute and relative return. It sounds technical, and it can be, but understanding this distinction is crucial for anyone investing, whether you're a beginner or a seasoned pro. Especially here in the US, where we have so many investment options. So what's the difference? Simply put, absolute return is how much money you actually made on an investment, regardless of what else is happening in the market. It's the pure, unadulterated gain or loss. Relative return, on the other hand, is how your investment performed compared to a benchmark, usually a market index like the S&P 500. Let's start with an example of absolute return. Imagine you invest $10,000 in a stock. A year later, that stock is worth $12,000. Your absolute return is $2,000 or 20%. It doesn't matter if the stock market as a whole went up 30% or down 5%. You made $2,000. That's the beauty of absolute return. It's straightforward. It focuses solely on your gains or losses. A negative absolute return simply means you lost money. If your $10,000 investment fell to $9,000, your absolute return is negative $1,000, or minus 10%. Now let's look at relative return. Let's say again you invest $10,000. This time your investment grows to $11,500, a 15% return. Sounds good, right? But what if the S&P 500, your benchmark, grew by 20% during the same period? In this case, your relative return is negative. You outperformed the market in terms of dollars gained, but underperformed when considering the overall market growth. Your relative return would be minus 5%, 15% return minus 20% benchmark return. Why is this distinction important, particularly for US investors? Well, we're bombarded with information about market averages. The news constantly reports on the Dow, the Nasdaq, and the S&P 500. These are benchmarks. Everyone talks about beating the market. That's relative return. But focusing solely on relative return can be misleading. You might be happy with a 10% gain, but if the market went up 15%, you're still underperforming. Think about hedge funds. Many hedge funds don't aim to beat the market. They aim to deliver positive absolute returns regardless of market conditions. They're trying to make money even when the market is going down. This is often called absolute return investing, and it's popular with institutional investors and high net worth individuals. They're less concerned with keeping up with the Joneses or the S&P 500 and more focused on preserving and growing capital in all environments. Let's do another example. You invest in a bond fund. Bonds are generally considered less risky than stocks. Let's say your bond fund returns 3% in a year. The stock market S&P 500 skyrockets and gains 25%. Your absolute return is 3%, which is a positive gain. Your relative return is significantly negative. However, if your goal was capital preservation and a steady, albeit modest, return, a 3% gain might be perfectly acceptable, even though you underperformed the stock market. Now, consider a scenario where the market crashes. You invest in a strategy designed to protect against downturns. Let's say your investment only loses 2% while the S&P 500 drops 20%. Your absolute return is negative 2%, but your relative return is a positive 18%. In this case, you significantly outperform the market by minimizing losses. This highlights how relative return can be a more meaningful measure during periods of market volatility. It's also important to understand that both absolute and relative return have their limitations. Absolute return doesn't tell you how well you did compared to other investments, and relative return can be misleading if the benchmark isn't appropriate for your investment strategy or risk tolerance. So which one should you focus on? The answer is both. A well-rounded investor should monitor both absolute and relative returns. Absolute return tells you if you're making or losing money. Relative return tells you how your investment is performing compared to the broader market and helps you assess whether your investment strategy is on track. Consider your financial goals, your risk tolerance, and your investment time horizon when interpreting these metrics. Are you trying to maximize gains, preserve capital, or generate income? Your goals will influence which type of return is more important to you. To quickly summarize, absolute return is the actual gain or loss on an investment. Relative return compares your investment's performance to a benchmark. Both are crucial for evaluating investment success, and the emphasis on each depends on your individual financial goals and risk profile. Don't get caught up in just beating the market if that isn't aligned with what you're trying to achieve. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.